like to talk a little bit about how directors play with capital and how they manage to exit the equity in their company. And when a company comes to market and there's a high personal interest from the original founders, the original directors, it's always a positive thing. I'm happy to invest long in a company where there's skin in the game, where the directors themselves have a high equity interest. Now, let's look at Capitec as an example. This is not investment advice, I'm just providing an example. So, when Capitec came to market, the investors were highly invested. Michiel Leroux, Rian Stassen, all the original guys, Andre Duplessis, who was the CFO for 21 years, has in a sense left Capitec. We know Michiel Leroux was the biggest shareholder, other than PSG, Yanni Maton. And PSG had about 59% when Capitec came to market. And then what happened is they started raising a lot of capital. But they did so through rights issues, which PSG underwrote. And it was very interesting. So let's say that the share price had accumulated to 200 Rand in the first rights issue. I'm just using an example for simplicity. They would say, okay, we're going to issue a 50 Rand nil-paid letter to all existing shareholders. And you can subscribe to new shares at 150 Rand a share. You can sell your nil-paid letters if you don't want to and collect your 50 Rand. Or you hold on to them and you buy Capitec for 150 Rand. Now keep in mind that although investors could do that if they didn't want to take up their rights, so could PSG. And no doubt, and in fact you can look into the records yourself, PSG did create a lot of cash by selling no-paid letters, because whatever wasn't taken up, they would have had to subscribe for anyway. And as it so happens, most of those rights issues, I think perhaps all of them, but I stand to have that checked out, were oversubscribed. People took them up. There was no need for PSG to underwrite. So let's say these rights issues continued all the way until 500 Rand a share. And at 500 Rand, the rights were at, say, 350 Rand, and the nil-paid letter was 150 Rand. PSG could create cash by selling the nil-paid letter. And over time, as the rights issues happened, PSG became diluted, and their 59% started shrinking and shrinking down into the 20s. Eventually, PSG announced that they'll be unbundling what was left of Capitec to all shareholders. And of course, the shareholders of PSG got Capitec, and now because Piet Maton decided to hang on to Capitec for a little while, but he was free to sell all of those shares without having to disclose it to the market. As we stand today, PSG, Piet Maton are completely out of Capitec. Michiel Leroux, one of the original founders, has written at least 6 collar structures. Now, for those of you that don't understand collar structures or zero fee collar structures, I'm going to try and make it simple by maybe using an analogy of, let's say there's an investor that owns a block of flats. Let's say he's got 10 flats or apartments, and each of them are worth 2.5 million Rand. And he goes to a financial institution and he says, listen, I don't want to sell all of these apartments right now. In the case of a director of a market, if he went and he wanted to quickly sell all of his shares, it would spook the market, and the remaining directors won't be very happy, and he might want to get a few dividends and things like that. He might think that there's further upside potential, but he says to the financial institution, he says, look, I want 2.2 million for each apartment now, and the security is the flat. You've got the flat. If the market drops out of the flat in the next 3 years, you can sell it. It's now worth 2.5. You're lending me 2.2. I can spend my 2.2 million now, and if it drops down to 2.2, you by all means sell it and you get your your money back. If it goes up though, you benefit from the upside, because I believe in 3 years time it's going to be worth 2.8 million. And so the financial institution's happy to do that. In fact, they may even say, okay, I'm not going to sell it at the 2.2 that I lent to you. I'm going to sell it when it gets to 2.3 or 2.35. So there's enough of a buffer there, just in case, you know, especially if it's a zero cost. So on a zero cost collar, there's no interest involved. So that's how the structure would work. Now, I've tried to simplify it. What Michiel Leroux has done with his Capitec shares is he set up these collar structures with Goldman Sachs, but not 2.5 million, 2.5 billion, several of them. And whenever Capitec's share price drops, like it did around the time of the Viceroy report, and like it did at the time of the COVID profit warning, it dropped below that collar structure and it triggers a sale. The real sale actually happens though, not when the investment bank decides that they want to sell their shares on the market. The real sale actually happens when Michiel Leroux sets up the collar structure, because he's got his cash in hand. There's very little concern about what happens to the share price over the next 3 years. It's the bank that's protecting themselves. So I see a collar structure which is set up with these put and call options. I see the collar structure as really a sale. And so earlier this year, in about May, Michiel Leroux put another 2.5 billion out. And I'll say this might be the 6th or 7th time it's happened. And yesterday we saw Lawrence sell just over 30 million. I think Harry Fourie sold about 56 million earlier than that. And you can be very sure that the CFO, who resigned at the end of June, has had the whole of July and now half of August to sell his shares. The reality is it's not unusual. I mean, First Rand, GT Ferreira, Laurie Dipena, all of these guys held a lot of equity when it came to market. There's RMB, and then Rand Consolidated when they merged. They obviously don't have that kind of equity. None of the big banks have a lot of the original founders as shareholders. These guys exited. That's why they start their bank, and it helped create wealth, and they exit at the right time. So it sat with me that Piet Maton said a few years ago that he'd be surprised if Capitec went over 1,500 Rand a share, and he would likely be a seller around those prices. And it's very interesting that PSG exited, I believe, under that price range, and yet it's gone through the 2,100 Rand a share mark. It's on a PE of 29. It's on a market cap of 350 billion. Capitec is on a market cap of 250 billion Rand, billion with a B, and its combined value is about the same as both Absa and Nedbank together, that have been around much longer. Nedbank, as we said, acquired the Boyland banks, the BOEs, all of these old banks. Absa was Amalgamated Banks of South Africa. It was the old Trust Bank, Volkskas, United Building Society, all of these banks that came together. And so if you look in history, South Africa has gone through cycles of various banking crises, and the South African Reserve Bank realizes that they're not going to just hand out banking licenses to everybody. Even this recent Ubank that is gone under curatorship was made by Equal Survey, originally Sikanjala, I forget what his companies are now called, owner of independent media newspapers, AO Technologies, very controversial fellow. If the governor of the Reserve Bank decided that he wasn't going to give the license of Ubank to Iqbal Survey because of the controversial fellow he was, or if it was just a general announcement. But the announcement seems to be, according to Independent Newspaper Group, which again, one needs to understand the source, they say that they're not interested in selling Ubank to anybody but one of the existing big four banks. Ubank's quite interesting because it operates again very close to many of Sabanya's mines. Sabanya's had an extended strike earlier this year. Part of the reason for their poor results on the gold side is certainly attributable to that extended strike. But that was partly self-inflicted, in my opinion. How the CEO can pay himself 300 million and allow workers to continue a strike over what essentially is 0.5% also bears questioning. Nonetheless, in the same areas in which Ubank operated, which was in the mines, mostly gold mines, in the Free State, in Witbank, in these areas, they struggled to get their money in while these guys were not getting paid during their strike, and that's probably why they went under. Capitec also operated in these areas. I'm not sure how they handled it. They probably gave these guys access facilities or second loans, but I really don't know. Maybe they wrote them off as bad debts. We'll have to see when the financials come out if there's any mention of that. And it's probably not as significant in Capitec's scheme of things, because I think that they lend far less than 7 or 8% to the mining industry. Their biggest industry is about 42% to the public service sector, government officials. That's also a little bit of a worry for me for discussion on another day, because we've been talking about halting increases or cutting in the wage bill for public servants. South Africa's got away with not doing that, even though there was a promise to do so, even from Tito Mbowene's days. And the reason, I think, is mostly because we've had a bit of a commodities run, and as a result it's resulted in a trade surplus for South Africa. But that trade surplus is slowly going to dissipate. We're now heading into a recession, and we've got to watch our expenses. We can't just carry on borrowing from the World Bank, although that doesn't seem to be too much of a concern for those governing at the moment. So obviously Capitec can't grow their client base forever. Originally they were talking about 200,000 new customers a month, then 150,000. I mean, they reached an 8 million mark, and maybe close to 10 million active digital customers. But we only got 1.4 million taxpayers in this country. Fair enough, we've got about 18 million of people that are on social grants, and maybe many of them bank with Capitec because it is a low-cost bank. And maybe they can continue to get bank fees, but there will become a time when there will be resistance to those fees. As I said before, there's offerings from Time Bank, there's offerings from Bank Zero, which has zero costs. ShopRite has absolutely no monthly costs, but it does have a R5 withdrawal fee. And so many of these clients that use Capitec would have ordinarily used cash, and sometimes they still just get their salary deposited in the bank account and go queue at an ATM to pay their R8 or whatever it is to withdraw their money. If they can get R5 withdrawal from ShopRite and the queues aren't as long as the Capitec ATMs, why wouldn't they move? South Africa is obviously moving towards a cashless society, but we are far away from that. And for that matter, if we do go cashless, we've got cell phones. What do we need banking institutions for? What do we need ATM infrastructure? What do we need 830 or 840 branches for? to sell funeral policies, to flog funeral policies. A very old style of doing things. That's Capitec's business model. Capitec just spent probably close to R1 billion, but let's say 900 million because that's more the figure that they're disclosing, on a head office. It always worries me when any financial institution indulges in such luxuries. Some might argue that the head office was necessary for company culture or whatever it may be, but the fact is, just after it was built, COVID happened, and most people were still able to operate at home from the comfort of their home. The whole call center operated. I mean, get people in to monthly events and team spirit building if you want to create a culture. And I really wish that more and more offices would close down and that large corporations would consider remote work. And if it's not for 5 days a week, at least have smaller offices. Mike Brown seems to think that it's working out quite successfully. In fact, Nedbank have reduced their costs down, their cost to income ratio down to below what Capitec's cost to income ratio is. I'm cost conscious, whereas Capitec are employing people, growing branches, and they've got the complete reverse model. I mean, they started at a 36% cost to income ratio and are pushing towards 50%, whereas Nedbank were at one stage in the 80% cost to income bracket at about the time that Capitec came to market, and they've reduced their cost to income all the way down to 51%. That says something about management. On the one hand, we have managers in Capitec with a sales culture, but not controlling expenses. And I'm not convinced that their business model is that sound. None of the other banks wanted to get into the same markets that they are. There's a cap on what they can charge in terms of transactional banking fees in the market in which they're attracting and the market in which they operate. And as I've said before, I have a bit of a concern about the risk that they're taking on their book, both on the business banking side and on the personal credit side. But the point of this is not about Capitec itself. It's more around the fact that once shareholders are out, the consequences of what happens to that company after they've sold their shares, after they've resigned, new directors come in place, is irrelevant. The founders have made their money. Their objective was to be selling shareholders to pay themselves salaries and bonuses, irrespective of whether it's approved by shareholders or not, and basically to siphon out as much as they can until they retire comfortably in their houses, in the Manus, wherever it may be. I'm not saying that Gerrie Fourier's house is literally 2 blocks away from market. He's Joosta's house in the Manus. And I'm not saying that after he started building, he decided to knock it down and adjust the plans and build an even bigger house. But if that were true, then it would make you think, should you be investing in a company on a price-earnings ratio, historic price-earnings ratio of 29, even when there's questions around those historic earnings, on a price-to-book, the most expensive price-to-book in the banking industry ever, in the world, not in South Africa, in the world, like a 6.7 price-to-book is just unheard of. Most large, big, established companies are trading at discounts of price to book. And you might say, well, maybe they've been efficient with the capital. No, I think they've got a lazy balance sheet. They haven't been very effective with their capital. ROEs, ROIs are ratios that analysts use and that certain members on the board are very keenly aware of. It's not necessarily a true reflection of the value of the company. Keep that in mind. Point is, you really want to be backing a company where the directors have skin in the game. where the directors are interested in growing the share price, not for the share appreciation rights that they can personally receive, but growing the share price because they're going to be holding on to it as a legacy for future generations. It's their name that's behind that share price. It's their legacy.